We are looking to share an eclectic mix of topics and interests directly from our local communities of color that present opportunities for meaningful dialogues. People are yearning for different stories from diverse voices, topics not covered extensively in our local media outlets. To ensure new points of views are being heard, we continue to share these stories on a large-scale platform. We seek to educate, we look to motivate, and we want our voices to amplify.
Hey, welcome to Amplify, produced by RISE Chattanooga, every Wednesday from 9 p.m. to 10 p.m. on WUTC, where we give you a mix of topics and interests directly from communities of color. I'm Roland McIntyre, your host for this evening, and I'm so glad you're here. Tonight, we're talking taxes. Yes, it is still not too late to get those done. That deadline is fast approaching. That deadline is April 18th. You have time. Let's get it done. Do what you got to do. But we want to help give you some tax information tonight to give you some motivation to get this thing handled by the deadline. So just keep in mind, though, that this information that we're going to be providing is going to be for financial education purposes, and it's going to be general in nature. It's not going to be specific tax advice. If you're needing specific tax advice, please consult your tax expert, your CPA, your accountant, so that you get the specific advice you need for your situation. So keep that in mind in our conversation. Okay, with that out of the way, let's talk about the I to the R to the S. So that income that you make from your job, guess what? The government's going to tax it. Hey, that income that you make from your business, guess what? The government's going to tax it. Oh yeah, and you investor, you didn't escape either. That money that you make from those investments is going to be taxed as well. Even the interest from the bank is going to be taxed. So, yes, are there exceptions to the rules on some of these things? Yes. And that's where taxes come into play. That's what the different types of accounts come into play as well. But for the most part, you're going to be subject to taxes when you have these things occur. So when you make money, just know that there's going to be some taxes that you're going to have to pay. Now, we're going to be really talking about taxes on the federal level, not specifically on the state or local level. We're going to really keep it on the high federal level so that we can make sure that the most amount of people can know what we're talking about there. When we start getting into state and local taxes that may or may not exist for some of you in the area, that can get a little too much into the weeds. So the thing I'll say about state taxes is in Tennessee, we don't have a state income tax, but there are businesses that have to pay taxes. So keep that in mind. And then we have our folks here in Georgia that do have to pay a state tax. So keep that in mind as well. So on our federal taxes, we really want to look at, one, how much money we're bringing in for the year. If you don't know how much money you're bringing in for the year, how in the world are you going to know how much you're going to end up paying in taxes if you don't even know how much you're bringing in? So that's just first things first, is how much are we bringing in, and then where is that money being made from? So a good idea for you to do, especially if you're someone that is a part of the gig economy and you also have maybe a full-time job on top of that as well, you have income coming in from multiple sources. So you need to figure out how much you're going to actually make in total before any taxes are taken out, before anything is taken out. You need to see how much you're making. And you can easily find that information out from a couple of places. Especially after the first of the year, you're going to start receiving these things in the mail or through email, which are called W-2s. So if you work a job where you are paid on an hourly or salary basis, you're likely you're going to receive a W-2. I'm going to say likely, maybe there's some exceptions out there, but you're going to receive a W-2, and that's just going to tell the IRS, and it's also going to tell you how much you made for that year. It's going to have a few other boxes on there, but that main thing that you're going to see on the top there is how much you made for that year. Now, there's going to be other forms that show you your income as well. If you, let's say, drove for Uber or DoorDash, or if you had some type of other contracting job where maybe you were not paid full benefits, but you were contracted to do a certain a certain type of job or provide a certain service for a limited amount of time, that then you were likely provided what's called a 1099, a 1099 miscellaneous, perhaps, where it was just listed as 1099 MISC. If that's the case, that income also is going to be reportable to the IRS. And note, I'm saying reportable. That means you let the IRS know about it when you file your taxes. You're just letting the IRS know that you made this money at this point. We're not talking about how much of it's going to be taxed. Some people will qualify for deductions for some of their income. Some will not. Some actually are able to reduce that amount, whereas others will have to pay that full amount that they make. All of it is subject to being taxable. So keep that in mind. Yes, so check that pay stub, check that W-2. You will see itemized items that show your taxes being taken out. You will see unemployment. You will see Medicare. You will see your state taxes. If you're in Georgia or another state that has a state tax, you will see those items coming out. Either it being on your pay stub or your W-2. Now, your 1099s may not have this information. So you will have to look at that when you file your taxes, but that doesn't mean that you don't owe taxes because they did not withhold it. It's the type of job, it's the type of career that you've chosen where maybe they were not required to take that out of the check that before that you were paid. So keep that in mind. Just because you don't see anything taken out of your check doesn't mean that you don't owe anything. If you make income, you likely will owe something to some government, whether that's federal, state, or local. So keep that in mind. And if you do have that type of situation, you definitely want to be putting money to the side. Small business owners, you want to really consider making quarterly payments so that you don't get behind and that it becomes such a large tax bill that you can't keep up with. These are the kind of things that are going to be very important for you to consult that tax advisor and that CPA, that bookkeeper, those people on your financial team, that financial advisor, to make sure that you're doing the necessary things so that you don't put yourself in a situation where you're having to come up with a large tax bill each year that you could have really broken down and actually put money aside for or paid on a different interval, so that it's not so much that you have to pay all at once. So keep that in mind for my non-salaried, non-hourly workers who are receiving a pay amount that is not being withheld for taxes. So those taxes are not being held, so you don't necessarily know how much you owe from that. Well, I do want to at least talk about the federal amounts. We call these ordinary taxes. or the ordinary tax bracket, the marginal tax bracket, where you know that if you make a certain amount of money, how much federal taxes that you're going to be subject to. These tax brackets include the 10% bracket, the 12% bracket, the 22, the 24, then a jump to the 32, the 35, and last, the 37% tax bracket. Now, the range between these brackets varies depending on if you're head of household, if you are married filing separately, if you're married filing jointly, or if you're single. These are going to be factors in whether that bracket is going to have a broader range or a shorter range of your income that's going to be taxed in it. So every person is going to be on the first portion of their money in an ordinary tax situation. It's going to be taxed at 10%. The next set, once you cross that threshold of 10% and you've filled up that bucket, you could say, the next amount is going to be 12%. The next portion of your money is going to be taxed on that 12%. Then the next portion is taxed on 22. It's not set in a way where you pay just that one number. You'll hear people say, I'm in the, let's say, 22% tax bracket. And a lot of people think, hey, I make $50,000 that a year, so I have to pay 22% on that money. That's not the case. If you're single and you make $50,000, yes, the top bracket that you pay is the 22% ordinary tax bracket, but you're not going to have to pay 22% on that $50,000 like that. Instead, there's going to be a portion that you have to pay 10% on, a portion that you pay 12% on, and then that last portion you pay 22% on. And someone may think, hey, that's even worse. Actually, it's better for you because you're going to be paying lower amounts. So when you do the calculation on that, that actually brings what's called the effective tax rate down for you. So when someone says they're in the 22% tax bracket, just know that's the bracket where their income, the income that they have, that's the highest amount, and that's the threshold that they're in. That's not how much you're actually going to be paying in taxes for that total amount. So keep that in mind when you're looking at your taxes and when you're trying to do estimates or looking this up. Don't think that you're going to have to pay that top amount that you make there. Now, another thing to look at are the capital gains brackets in comparison to those ordinary tax brackets that I just gave you, where I gave you, hey, that lowest amount is 10%, the lowest amount is, then the second lowest is 12, then 22, on and on from there. Well, when you look at long-term capital gains tax brackets, it's going to be different. Well, you may have the question of, well, what is the long-term capital gains bracket and how do you qualify for it? Well, first you have to have an investment where you had a successful investment and you gained some money off of that investment. So instead of taxing that money in the ordinary tax bracket, you are in what's called the long-term capital gains bracket if you held that investment for at least a year. If you didn't hold that investment for at least a year, then that gain that you had will go right into that ordinary tax bracket on top of any additional money that you made from your job. So in order to qualify, you got to have that year and you need to have had a gain from an investment. So what do I mean from an investment? That may be from a sale of a rental property or an investment property. That may be from a stock investment. So we're talking about investments like that. You bought something for a lower price. Over time, it went up. That time has been over a year. Now you sell that item. It's when you sell it, that's when you realize the gain. Once you sell it, that's when it triggers the taxes. And whatever the profit was, that's the gain. That profit is what's going to be taxable. So not the full amount that you actually put into the actual investment, but the amount that you gained off of the investment. Okay. So when you look at those long-term capital gains rates, what's the big difference there? Well, those rates actually don't start out at 10%. The actual long-term capital gain rate, the lowest bracket is actually zero. Yes, and it's pretty significant, especially if you're married filing jointly, and we'll get to that in a second. The lowest bracket is zero, the next bracket is 15%, and then the third one is actually 20%. And I want to come right back to the thing that I mentioned there is that married filing jointly 0% tax bracket, because I know there's a lot of people out there that can actually fit into that bracket for certain investments gains, that when they have those long-term capital gains rates where they actually qualify for that zero capital gain tax rate. And how that's done is, hey, if you make, for example, under that threshold, and the married filing jointly threshold is roughly around $83,000 a year. Now, you also have other deductions that can bring that if you make more than that, there's other deductions that can bring you under that $83,000 number. But if you're under that threshold and you also have some gains that are from investments, you won't have to pay any capital gains on the amount of the gain up to that amount, up to the 83 or so $1,000. So let's just say you make $50,000 a year and you're married filing jointly. So the household made $50,000 a year. And then you had some investment gains. Let's say they were $10,000. So in total, your household made $60,000. That's great. That $60,000 is going to be subject to taxes, but how much of it is subject to taxes? Well, the $50,000 is going to be to those ordinary tax, that ordinary tax bracket, where it's going to have to go through that system that we talked about, that a portion that's 10% and on from there. Whereas this long-term capital gains rate, the gain portion, that $10,000 that was gained, it is going to be taxed at the 0% tax bracket. There's nothing there. And you just remember, this is, please consult your tax advisor. But in the example that I'm providing to you, this is just an example. You're not subject to capital gains in that situation. You held the investment for a year, you make under that threshold. This is an example of how you're going to be taxed less than someone that made that $60,000 and they were married filing jointly. Their $60,000 from a salaried job they would actually have to pay a higher amount of taxes than someone that made a portion of their money from capital gains and then a portion of that money doing ordinary taxes. Now, the total amount may be the same, but they're going to pay less taxes if some of that money was made from long-term capital gains. So that's one of those ways where people wonder, how are people that are making just the same amount of money as maybe I am, but they're paying less in taxes? This is one of the ways. Where your money is coming from maybe a salaried role, whereas their money is coming from investments. Their money is actually not going to be taxed at that ordinary tax rate. So now they get to keep more of their money. So this is just a small example of how the tax system works. There's several different things like this that many people don't realize or take advantage of, or see the power of investing, see the power of tax planning. When people know these things ahead of time, they can prepare and make decisions that's going to be better for them financially. That's why it's so important to work with tax professionals. That's why it's so important to work with financial advisors and professionals that can help you actually see these things coming. Saving in your retirement accounts, like your 401ks, your 401k, your 403b, your IRA. You maybe have a Roth account, whether that's a Roth 401k or a Roth IRA. These type of accounts actually do provide tax benefits. They're actually in the IRS code. The information is something that the IRS has created, where you actually are going to receive a tax benefit in some shape, form, or fashion by utilizing these type of accounts to save for your future. There's even health savings accounts for your health, where you can also get tax deductions that are tremendous tax saving vehicles for your family. So you want to actually be aware of these things so that you're not just necessarily putting the money in these accounts just because you want to, but it's actually more strategic, and that you actually are benefiting in that so that you can actually reach your goals quicker. You may want to save for retirement. You may want to save for your kids' college education fund. You may want to just save some money for a rainy day. And you want to make sure that money is growing and outpacing inflation. So you invested in the stock market in a brokerage account, and you hold the money in that account for a year without selling the actual investment. That would lead, for example, to that potential gain, if there is one, to be taxed at the long-term capital gain rate. If there's a loss in that situation, what if you lose money in that situation? Well, there's a potential tax deduction for you in that manner too. If you took an investment and the investment didn't work out, there's capital losses that you could potentially take as well. So there's rules, and there's up to a certain limit each year, but those things are available to you. And if you're not telling your tax preparer, your tax planner, your financial advisor, these different things that you're doing throughout the year, then they can't help you. If they don't know, they can't help you. So you want to be making sure that if these companies are sending you 1099s, W-2s, this information to you in the mail, that you're making sure you're providing all of that information to whoever is doing your taxes. If it's you doing those taxes, yes, you need to go on those different accounts, those different websites where they're providing the tax document. It may be listed as a 1099 INT from your bank. It may be from your retirement account as a 1099-R. It may be from your contracting position as a 1099 miscellaneous. The point is, it's a tax document. It needs to be put in a place where you can locate it and provide it and have it all in one place, so you can make sure all of that information is being reported at minimum, is at least so it can be reported. But then also, so how can you start using this data, this information, to benefit you when you file your taxes, and how you can file your taxes in a way that's going to lower your taxable income and lower your tax liability in future years. That's what it's all about, is lowering your tax liability, not just this one year, but going forward, being tax smart when you make these decisions. You're going to do certain things in your life anyway. Why not get the tax advantage for them, so you can keep more money in your pocket and do more things for yourself and for your family? Go on the vacations or whatever the case may be. Heck, if you're a business owner, those trips and some of those things can be written off as well. So you need to make sure you're having the conversations with your tax advisor and making sure your business is properly set up, and actually, so you can actually take advantage of these. If you are operating as a business and not getting the advantages that business owners have, well, then you're missing out. You really are missing out, and you're missing out on the opportunity to really grow. So keep that in mind. If you're looking to purchase a home, you're going to need to talk to professionals, where they may say, hey, you're getting all of these tax deductions, but now that's going to mess up your qualification potentially to buy this home. So knowing ahead of time what your goals are, talking with a professional can really make a big difference in how your tax situation can really affect so much in your life. So I just wanted to talk to you guys as tax season is here, and that deadline is right around the corner, to motivate you and also for you to start thinking about some of those things that you've done throughout the year and previous years. And you're like, oh man, I missed that opportunity to actually lower my taxes. Maybe I did have some high medical bills. Maybe I have been missing out and not utilizing my health savings account or my 401k accounts, or I held that investment for 360 days. And if I would have waited 7 more days, I could have actually taken advantage of long-term capital gain rates rather than a short-term capital gain where now that money has to be actually taxed at the ordinary higher tax bracket. Just little things like that, and knowing those things ahead of time can make a big difference in your tax bill. So hopefully this has been helpful to you. Hopefully you are getting the information from your professionals that can help you save on your taxes. My name is Roland McIntyre with Mountaintop Wealth. I'm a financial advisor myself, but tonight this information was for your financial education and was general in nature. If you're looking for specific advice, you can contact me at www.mountaintopwealth.com and schedule an appointment, or you can reach out to the slew of financial professionals that are available to you online and reach out to one of them, have a meeting, have a consultation, let them know what's fully going on with you so that they can actually be of assistance to you. It's no time like the present to get that going. So use this talk tonight as motivation for you to get things done.